Hi, my name's Brent Joyce, Chief Investment Strategist for BMO Private Investment Counsel. We're here to cover August's main themes that drove capital markets. August brought a reality check to global capital markets as rip-roaring stock market gains took a breather. Unfortunately, with the key theme for the month being rising real bond yields, the bond market also faced headwinds. Let's unpack some of these issues and see where it leaves us. Bond yields in general have been rising for over a year, with negative implications for many assets. But when the real yield component is rising, the impacts are more acute. The good news on rising real yields stems from the fact that economic growth is looking better in the U.S. If the U.S. economy wasn't expected to continue humming, we wouldn't likely see real yields above 2%. Now, the rest of the story isn't so rosy, and it stems from supply and demand for U.S. government debt. So the U.S. Treasury announced a heavier than expected debt issuance schedule, and that's of course to fund the ballooning U.S. budget deficit that has grown to more than $2 trillion in the space of a short year. On the demand side for U.S. debt, central banks aren't just raising interest rates, but they're selling previously purchased government bonds too. Now this requires finding buyers for both new and old government bonds. Foreign appetite for U.S. debt isn't what it used to be either, with Russia, China, and Japan all trimming exposure. To pile on, credit rating agency Fitch downgraded the U.S., citing concerns over the nation's mounting debt and what appears to be an apathy or certainly no plan toward how it might be reined in. While this discussion of real yields leans towards some of this unpleasant mathematics, modestly positive real yields, they should be welcomed, not feared. Bond yields, after all, are the price of money. It shouldn't be free. Humanity wastes resources when they're cheap, and money's no exception. If nothing more, higher real yields reward savers, and they curb profligate government spending, and they impose discipline on both households and businesses over our investment and spending decisions. The adjustment to higher real yields is a finite event. The pain will subside. The increase in real yields sets the stage for a healthier economic and investing landscape as we move forward. For bonds themselves, yields rising for any reason, whether it's the inflation component or the real component, that's bad news for investors already owning existing bonds. As yields rise, bond prices fall. However, there is a silver lining. Eventually, the income received from those higher yields repairs the damage, but it does take some time. For stocks, rising yields pose several problems. Most companies borrow, of course, so the higher interest costs eat into corporate profits. At the same time, the higher the interest rate, the lower the present value of the stock. Now, if yields are higher on inflation alone, stocks do have a fighting chance. That earnings stream, it's expected to grow with inflation. If companies aren't raising prices, then there is no inflation. If yields rise due to rising real yields, on the other hand, stocks have less defense. Lastly, higher real bond yields are more attractive to investors than simply higher yields due to inflation. Stocks, also a real asset, face stiffer competition for investors' money when bond yields offer higher real yields. We see August's low, these single-digit checkbacks for equity markets, as part of a healthy and normal consolidation of what have been pretty good gains so far this year. The price declines do leave equity markets with more attractive valuations. Meanwhile, corporate earnings growth is coming in better than expected, and the outlook for 2024 is brightening, with earnings growth forecasts of roughly 10% in North America. When we combine all this, we do see room for stock markets to make additional advances in the year ahead. And the higher bond yields mean better forward-looking prospects from the bond market. Thank you for listening. That's our August market recap. We look forward to seeing you next month.